Welcome, curious minds, to Market Brain. Today, we're dissecting one of finance's most iconic, yet often misunderstood, indicators, the VIX. You know it as the fear index, a barometer of expected turbulence in the S&P 500. But what if I told you the VIX, as a concept, is far more powerful and pervasive than its single index application suggests? It's not just about the S&P, it's a methodology, a lens through which we can perceive anticipated chaos across any optionable asset. At its core, the VIX doesn't measure past price swings. It's a forward-looking gauge, derived from the prices of a basket of S&P 500 options. Think of it like this: if everyone is buying insurance options against a future market crash, the price of that insurance goes up, and so does the VIX. It's the market's collective prediction of how much the S&P 500 will bounce around over the next 30 days. Formally, the VIX is a weighted average of implied volatilities from a wide range of out-of-the-money S&P 500 call and put options. The formula aggregates these option prices, effectively backing out the market's consensus on future volatility. It's not a simple average, it's a sophisticated calculation that ensures it reflects a variance swap rate. This isn't about historical standard deviation, it's about the square root of the market's expectation of future variance. Now, here's the kicker: if we can perform this intricate dance of option pricing and aggregation for the S&P 500, why limit ourselves? The methodology is robust. Imagine applying this exact same VIX calculation, with its specific weighting and interpolation rules, to a single stock, an ETF, or even a commodity with liquid options. This is precisely what the open source community, like the GitHub repo we're discussing, is enabling. This GitHub project provides a local Python CLI and web app to do just that. It takes the exact VIX calculation methodology and applies it to other optionable US equities and ETFs. This means you can generate a VIX-style 30-day implied volatility for, say, a tech giant or a specific sector fund. It democratizes the VIX, turning it from a proprietary index into a replicable analytical tool for any asset with sufficient options liquidity. The beauty is that the underlying mathematical framework remains consistent. We're still looking for the implied variance, $/sigma-2, that equates the observed option prices to a theoretical model. The formula for the VIX-style index, let's call it $VIX_asset, simply substitutes the S&P 500 options with options on our chosen asset, $S_asset. The core principle of aggregating out-of-the-money options across different strikes and expiries to derive a forward-looking volatility estimate holds true. Today, the actual VIX for the S&P 500 is around 15.03, showing a decrease of over 5% from yesterday. This tells us that the market's expected volatility for the S&P 500 has calmed down. But what about other markets? Is this calm widespread, or is fear simply shifting? By calculating VIX-style indices for Bitcoin or gold, for instance, we could see if their implied volatility also dropped, or if traders are bracing for turbulence elsewhere. This generalized approach gives us a much richer, multi-dimensional view of market sentiment. So, the VIX isn't a lie, but its singular focus on the S&P 500 can be misleading. The true power lies in its underlying mathematical framework, which can be applied to reveal the fear index for virtually any optionable asset. This generalization allows us to move beyond a single market barometer and gain a granular understanding of where expected volatility truly resides. It's about seeing the market's collective prophecy, not just for the S&P, but for every corner of the financial universe.